It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my fellow CFPs and business partners, Kevin Korhorn and Josh Gregory.
Should the recent surge in inflation impact your financial plan? How would you even define inflation? And how can you isolate your finances if inflation continues to trend higher? That and more coming up on this hour of the Wise Money Show.
If you have questions for the show, we'd love to hear from you. Engage with us. If you can do so a few different ways. Call or text 574-222-2000. It's 574-222-2000. Online, wisemoneyshow.com. And then all over our social media, wherever you're at, we are there as well. Search the Wise Money Show. All right, let's talk about inflation, Kevin. Yeah, I think we've learned a couple things about inflation this year. You can't print a gazillion dollars and keep prices down. I think we've also learned that transitory is a made-up term and does not apply. Like they basically transitory. So the Fed came out and said, well, inflation's going to be transitory, which everyone thought that meant, well, inflation would have a temporary spike. It'd go up and come back down. And then they came out and said, oh, no. We didn't say it was going to come back down. It was just going to go up really sharply and then wouldn't stay that sharp, which that's dumb. Right. That's inflation. You would say that the 80s inflation was transitory, right? Because it did go spike for 4 years and then it tapered off. So that's transitory. That's absolutely bogus. But the big question is, now that we know inflation's here, is it here to stay? What's driving it? And then how should it impact your financial plan? That's what we're talking about right now. Guys, so let's level the playing field. How would you define inflation? And what's causing it? Do you think it's here to stay? Let's just talk about that.
Well, if I was going to define inflation so that we can be on the same sheet of music here, is you would say the consumer price index. That's what most people think about when they think about inflation. And so we can look back over the past 20 years, and inflation's hovered around 2%. And that it's a theoretical basket of goods and services that a typical consumer might buy. So think like rent, food, transportation, and so on. And so the total cost of all these items is the CPI. Now the CPI, Consumer Price Index, has also been referred to as the CPI. And you say, well, why would it be the CPI? And would you ever think that it'd be possible that when there's reporting going on about certain economic news or whatever, that there might be a spin or a narrative that is created in order to get you to think one thing when the opposite could possibly be true?
I mean, I'm looking at September's CPI or inflation report right now, and at September, it's 5.4 over the year. Now, that's the highest since 1990 when I believe it was 5.6 or whatever, okay? So it's the highest in 30 years, almost the highest in 40 years. But here's to your point, Kevin. Mm-hmm. If you look down at shelter, okay, shelter has apparently increased at 3.2% over the past year. That is absolutely bogus. The average price of a house has increased 12% year over year. So we know that number as well, okay? Mm-hmm. And we know rent has increased significantly as well. How is shelter only up 3.2%? That is absolute malarkey, in my opinion. So.
Yeah, it makes you wonder how they gather this data. And I agree that this feels like one of the most manipulated numbers out there. And but it's the one that everyone reports on. Mm-hmm. I still think, though, that CPI or seeing prices increase, that's still more of a symptom than it's truly a definition of what inflation is. I go back to, the textbook definition is too many dollars chasing after too few goods. But even that is a symptom.
Yeah.
You know, what happens is we live in a society where our central bank, the Fed, can print money. And it's no longer just literally putting ink on paper and putting more dollar bills out into the economy. It's all digital these days, and it's deposits electronically into these these banks' coffers. But when you can just dramatically increase the amount of money that we say is out there in the economy faster than what the economy can even grow and keep up, by definition, you've got more money to go buy the same amount of goods or a similar amount of goods. And so what happens is you just have this bidding up of the cost of everything in society.
Which is why if you actually get into it, there's an undercurrent of folks that were just very economists, very frustrated and disappointed with all the money printing, because there is an argument, a textbook argument, where that actually does nothing. That's a net neutral in the economy over enough time. That's a net neutral.
Well, and to me, the problem with the CPI, one of the many problems, is that most people do not aspire to live the CPI life. So the CPI life is not an elegant life. It's a great life if you want to live in your parents' basement, watch Netflix, and order Domino's pizza. Like that would
pizza, the ultimate
sounds pretty good right now.
The ultimate inflation killer, pizza.
I'm telling you, look at how pizza has done over time. I remember, when I was in high school 35 years ago, it was pizza. Right?
Yeah.
For $10 you get two
Little
pizzas.
Caesars.
Yeah.
And you can and here we are 35 years later, you can still get two pizzas for $10.
Yeah.
What a country.
So, okay, so Paul Tudor Jones, billionaire hedge fund manager, says inflation is now the greatest threat. The greatest threat to the market and to the average consumer. I feel the same. I'm just going to tell you, I'm not fear-mongering. I just think this cat is out of the bag. And to me, I don't think this slows down. I think the Fed and the average economist is expecting inflation, which is now over 5%, to drop down to 2 next year and be between 1 and 2 in perpetuity. Now, the thing we have going for us is technology is anti-inflationary, right? Technology is deflationary,
yes,
right? It
technology
will drive prices down.
Yes.
Love that.
Yep.
However, this is what happened to me yesterday. Still dealing with this poison ivy or whatever on my wrist. I think I've got a poltergeist. And so they sent me to get a ointment or something at CVS. Well, I show up to CVS and I didn't even get the notice that the prescription was ready. So I show up and I wheel around to go to the drive-thru. Drive-thru closed. We don't have enough staff. I walk inside, and the line from the pharmacy goes all the way to like in the middle of the store because everyone's waiting. No one has any. And sure enough, even though this was 8 hours after my doctor's appointment, I finally get to the counter, and she's like, okay, I can see it here. We haven't had any time to work on it. I'll get it done. It should be about 45 minutes. While I'm waiting, I'm going through my Twitter feed, whatever, and I'm seeing a notice for McDonald's offering starting wages at $21 an hour. These sorts of things, guys. Wages and the labor shortage is going to make inflation permanent.
I agree completely. In fact, so I had a similar story, although I wasn't picking up an ointment. Sorry about that, Mike. I was in Costco, just kind of cruising through the aisles and everything, and I came upon 2 Costco workers that were folding some clothes or something, and they were talking about how the wages kept going up and how much you can earn as a cashier at Costco, and they were kind of aspiring, I'm going to go for that job because there's openings and the wages just keep on climbing. And a lot of economists are saying, have often said, they don't really count inflation as a concern until it starts showing up in wages.
Because wages, once they go up, they're not going to come back down, and therefore that's automatically priced in. And while we're all cheering wages going up, we haven't seen wages go up in a long time. While we're all cheering that, we're all paying for it. That will be priced in. So let's talk a little bit more about whether inflation is sort of here to stay, but then more importantly, how does it impact your financial plan? That and more coming up on the Wise Money Show with Korhorn Financial Group. Hey, YouTube, thanks for being here. This is The Wise Money Show. You're at The Wise Money Show channel. Make sure you hit that subscribe button, turn on notifications, and if you like the content, like the content. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time, every Saturday morning, also on podcast at the same time. And it's a full hour because it also airs a couple, 3 now, radio stations in northern Indiana where our headquarters is. If you're not into a full 1 hour content, that's fine. We've got next Wise Step videos that air all throughout the work week as well. 10, 8, 12 minutes, something like that. Take one financial concept, apply it directly to your financial life. So if you're about trying to take your next wise step in your financial life, make sure you hit that subscribe button and turn on notifications so you're made aware every time we drop new content, and smash that thumbs up button. Thank you very much. Leave comments below as well. I want to share your comments about inflation. What have you seen? So love to hear it. The one I didn't want to say on the air is also at that same time. Our very own Kim Miller sends me an email saying, I have a great candidate for an internship who is currently at $16 an hour for an internship.
Wow.
That's insane.
Wow.
That's insane. And she's like, well, what do we do? And I'm like,
Do you roll out the unpaid internship program?
That's unbelievable. Because she's working at a bank. Meanwhile, the bank for Harris, where I have to go all the time, their lobby's been closed for the past 2 months because they don't have enough employees.
Yeah.
It's unbelievable what's happening.
I wanted to go get my labs done where I go and see my doctor. The lab's closed. I can't go there. I have to go to the hospital.
Yeah.
And so.
Oh, and CVS told me they were closing at 6. They were like, they said, all right, this will be ready in 45 minutes. As long as you're back in line by 6 o'clock, you'll be able to pick it up tonight. And I'm assuming, how are they closed at 6? Oh, it's because they have so few workers. Everyone's working, a bunch of hours, and then when they're done, they're done. Like, they got to shut it down.
I know,
No
but
second
here's
shift.
the thing, and the restaurants are doing the same things. But if you ran a restaurant, you have to do that because the few people that you have carrying all the burden.
Sure.
If you burn through them, you're
Right.
done.
That's right.
Yep.
So okay, so let's get totally dialed in on where we're going in this segment because one of the things
That 10 minutes went like,
right,
very,
through goose.
very, very fast.
So my concern. So here's what I think about. Like if I say that the government printed $11 trillion in the last 18 months. That's true, not true, because the government doesn't print money. It's a debt-based system, and there's a process that we go through to get that $11 trillion into the system. But the net effect, and to oversimplify, I would say the government printed $11 trillion. And to me, the concern is not that prices are going up. Prices aren't going up because stuff costs more. Prices are going up because dollars are worth less.
Right.
And my dad just is in the process of he by the time this airs, he's probably will have finished selling his house in Cape Coral, Florida. He had it appraised in March of this year they were refinancing something.
Okay.
And it appraised for I think $319, and they're selling it right now. So 6 months later, it appraised for $429.
Wow.
So do you think the value of that house is 30+% more in 6 months? So then the only explanation is there's just more money
Yeah. Floating around.
And so
Which is why I go back to that definition that Josh shared.
And so when the amount of, because all the money is, all the debt is a claim to future assets. And when the claim to future assets gets so out of balance with the potential future assets, then we're going to have a problem. So I do think that there's a craving for people to say, well, what am I supposed to do then?
That's where
right.
I want to get to. So if we want to add a minute or so and comment a little bit more with the banter, I'm good with that just because the first segment went so fast. But then let's get into application. Where are you going to see this? How does it impact
Because it is confusing. It's the same conversation we've had, right? Well, here's what you do. If you're confident inflation's coming, you lever up with debt.
So that's where I wanted to start, but I think what's going to be more appealing is how does this impact your retirement plan?
Yeah.
And how does it impact your investments? And then how does it impact your present financial position? So, all right. So any additional comments on inflation? In general, we can hit that and then apply it. So, does rising inflation, does it impact your retirement plan? Should that impact how you plan ahead right now for retirement? We're helping you with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. Here with me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. If you listen to that, throw those AirPods in, whatever. Just search the Wise Money Show wherever you listen to podcasts. Subscribe to it or follow it or whatever you're supposed to do wherever you listen. And rate the show. We appreciate that. All right, so we're talking about inflation, highest level in 30 years. We're on our way to having it be the highest level in 40 years. Will we get to 1980s style inflation? Lots of people say no. I think it's possible. I really do, with how much money has been printed. We'll see. But how should this influence your financial planning? Guys, before we get into that, any additional thoughts, comments on inflation in general, whether it's here to stay, whether it's temporary, transitory, other made-up words?
Yeah, exactly. Now, I think you have to plan as though this is here to stay. The price increases that you've seen at the grocery store, or if you're in the housing market or whatever, those prices are not going to come back down, in my opinion. And wages aren't going to come back down either. So if you're a business owner or a manager, you're in charge of hiring people, just recognize, you are in a competitive environment right now, and it's probably going to stay that way for quite some time. And a lot of it is just purely because structurally in this economy, we've got shortages everywhere you turn. And those shortages, anytime there's a shortage of anything, the price goes up. Mm-hmm. And if all of a sudden there was a flood of extras instead of shortages, the price would come back down. But when is that going to happen? If you think of employees and everything, demographically, we've got an entire generation that is marching into retirement, and it happens to be one of the biggest generations in history.
This is the question. If you enjoy talking about inflation or are on one side of this debate, when will we go from shortages to excess? That's when inflation will calm down. That seems like it's going to be a long time.
Well, and that comment is the reason why we're all horrible investors. Because the only thing that we can do right now, and the reason why we still are alive today as humans, is that we see what's happening and project it forward. So you look at the 100 ships sitting in the lobby of the ports, and you're like, okay, well, it's not going to stay 100 forever. It's going to go from 100 to 200,
right.
And that's how we're classically that's how we think, and everyone thinks that way, and so that's because that's how we're created. We're hardwired that way. So I think in order to do this, I don't see inflation reversing itself like the price of gas. I mean, we saw $4.26 gas in 2008, and we saw $1.75 gas a year or two ago. Yeah. So these various commodity prices and other things, there are certain events that can happen that can change that. But I would say, settle in and plan to pay $3.35 a gallon for a pretty good while here.
The Wise Money Show is a show about financial planning. A wise approach to your financial life is looking at all 6 areas of your finances and how they intersect, how they are interconnected, so that when you make financial decisions, you're bringing synergy. You're benefiting as many of those 6 areas as possible. And so when it comes to inflation, it's fun to talk about. I'd encourage you to do so over Thanksgiving. Maybe you'll throw some turkey or mashed potatoes at someone and get in this argument. It's fun. But what really matters is, hey, how's it going to impact your financial plan? And I want to start with retirement, because one of the 5 factors in your retirement plan is spending. But each of those 5 factors has sort of multiple components to it. In spending, you've got to factor in health insurance, you got to factor in vacations, you got to factor in your mortgage, blah, 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 but you have to factor in inflation. Guys, does this surge in inflation, should it impact your retirement planning, specifically even your assumptions on inflation into the future? What do you think?
Well, that's exactly how I was going to say that you ought to apply this concept that when you do your forecast to test whether or not your money is going to last as long as you need it to, one of the things that you have to bake into it is an assumption that life's going to keep getting more expensive. And for the longest time, we were coaching all of our clients to assume that life's going to keep going up at about 3% compounding over time. And that seemed crazy for a decade or more when inflation was always well below 2%. But now it's becoming more real, and it has to be something that you do test. Make sure that you aren't basing your decision to retire or how much to spend in retirement on the belief that what you know today is going to be true forever into the future. Life is going to keep on getting more expensive, and you have to build that into your forecast.
We've been using the assumption of 3% inflation. I think I'm still comfortable there because that's not the CPI life. That's real. Mm-hmm. And for a long time, people haven't needed a 3% increase in their lifestyle, but we've baked that assumption in because for retirement planning, you need to be close. Like your assumptions need to be close to reality. Otherwise, it's just pointless. But I would tell you, be in the ballpark, but conservative. So be close to what you think reality is going to be, but then err on the side of conservative. And so we've done that with inflation and assumed 3% on average each year forever. I know a lot of folks have had that number at 2% though, and to me, if that's you, or if you're using some online retirement calculator, number one, don't do that. That's not helpful. Garbage in, garbage out, and you're going to make the biggest financial decision of your life based off of bogus assumptions. Number one. Number two, though, if your retirement plan is using a 2% assumption for inflation, test it.
There's a huge difference in the probability of success for a retirement plan using a 2% inflation versus a 3% inflation because of the time value of money. And so just, if you're curious about that, ask your certified financial planner to just toggle back and forth, show you what the probability of success is at 3% versus 2%.
Yep.
So you can see it.
And you're going to be amazed, by the way. The other part with inflation and retirement plans is if we're talking about, prices going up and maybe wages going up and inflation, you might need to assume it's higher. To me, it puts pressure on how much you're saving, how much you're contributing. And I would make sure that within whatever the range should be for your situation, that you're contributing on the high end of that range. Now is a time you might have a little excess money floating around, and Lay's wants it for potato chips and whatever else. Your retirement wants it too. I would add more to your retirement.
If there was a category of spending in retirement to really pay attention to, and it's one that maybe you would give the least amount of attention to most naturally, it's the area of housing. And housing is actually the largest expenditure or category in retirement of spending. Mm-hmm. And the question is, can that be a relatively stable area of spending for you, or is it going to be dragged higher and higher with inflation as well? I have a client right now who got stuck because of the pandemic and everything. They sold their house up north here. They were moving down south, but couldn't buy a house right away, couldn't find a house. And now prices are just continuing to move against them. They're just renting. Mm-hmm. And they're getting to this desperate feeling like, oh my goodness, we just have to buy something. And that is an awful spot to be because that's when mistakes happen, right? Yeah. When you feel like you are backed into a corner financially and that's how you make your decisions, that is a tough spot to be. Yep. So don't let yourself get into that position.
And if you find yourself in that position, give me a call because I've got some sage advice for you.
I thought you were going to say just in case Dad's house doesn't officially close.
Yeah, no. So they bought a big old motorhome, but if you didn't know, you'd think it looks like brand new.
All right. So there's other areas of retirement planning, plus the rest of your financial life. We're going to talk about inflation, how it impacts you, that more coming up on the Wise Money Show with Korhorn Financial Group. you were watching the time, and then you started talking, and I'm like, he just totally forgot what time it was.
No. When I said that, you gave me the hairy eyeball, and I looked. I'm like, oh, it's 9/11. So, but dude, they're selling their house, and they have a 6-month rent in a nice campground, and I'm telling you, they say Disney is the happiest place on earth. It's not. A campground is the happiest place. You meet the happiest, nicest people ever at a campground because everyone's happy.
Because they're that close to being in a tent. And they're like, geez, I could be in a tent and wiping my behind with leaves.
And I've got they're not spending $17 on that hot dog either.
That's right. So yeah.
No, but you can. It's amazing. I mean, motorhomes cost more, but if you're willing to go back far enough in time, you can get some pretty incredible value. Mm-hmm. If you want one of your jobs to be maintenance man. And my dad gets into that, and I'm like, oh, that gene skipped a generation.
Did you guys see Austin's email?
So, anyway,
1 point, it came in where we want it.
Okay, that's why I don't have my phone with me.
Yeah.
Come on, Mike.
That was actually one that we want to know. And it's like, okay,
dude,
good.
No, seriously, Mike. I'm trying to focus here.
All right. Third segment.
What are we even talking about?
Let's focus on the third segment. So I don't think we'll be done talking about this, but we'll have to have a natural...
let's answer the question that the title of this is, which is how to adapt
RVs, right?
How to adapt your financial plan for inflation.
That's what we're talking about right now.
All right, let's do it.
Okay. How to adapt your financial plan for inflation. That's what we're talking about right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here, friends. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on the YouTube channel. You get all sorts of bonus content. We were just, I don't know, were we goofing off or actually providing content? I can't really remember. Go to YouTube, search Wise Money Show, and subscribe to the channel. You can see every episode and bonus content there. All right, so within retirement, inflation needs to be a factor in your retirement plan. And so we've talked about it from a spending standpoint. We talked about it from a how much you're saving. What about health insurance as well? You've got to make sure. We've always been assuming that health insurance costs were going to be rising at a faster pace than inflation. And it's very possible if you haven't been projecting your retirement in that manner, you may want to do so now. Additionally, though, on the income side, we know that you on Social Security, you're going to get a 5.9% increase. I'm not sure I would expect that from here on out as well. And so this is, again, where I would say be realistic with your retirement projections, but then on the conservative side. So I wouldn't expect, well, the Wise Money Show folks just said, run my retirement plan at 3% inflation and assume Social Security will increase at 6% every year. Nope, I would not do that.
Wouldn't that be nice, though?
Yeah, that
would solve some problems for a lot of people.
Yeah. Okay, so what about...
And create many more.
What about how inflation should adjust your financial plan in the area of present financial position?
So in your present financial position, you may see an increase in your wages, which is great. And what would be even greater is if the increase in your wages was able to keep up with the increase in the cost of the basket of goods and services that you need to buy. So I would go into a wartime mentality with this thing, and I would say, okay, what do I have to do? I have to begin by leading and managing the most challenging area of my life, which is me, and I got to get a tight rein on my expenses. I got to be knowing where the money's going. Once I know that, then I have to strategically say, what part of my balance sheet do I need to clean up? And I need to think, what are the things that I'm concerned about? I'm concerned about housing, if that's my biggest expense in retirement. What's my plan for that?
I mean, all of a sudden, so it's tempting, and we're going to get there. It's tempting to say, interest rates are at nothing and inflation's at something. Let me borrow as much money as possible. we're going to talk about that in just a second. But when it comes to your present financial position and inflation, you need to update your three bank account system. If all of a sudden things cost more, guess what? All of us have a to-do, and that is to add more money to our emergency fund. That is, if you have the same emergency fund right now as you did 3 years ago, no, you need to update it now. Second, in that delayed spending category where you're saving up money for a home repair or home remodel, a vacation, the next car, the car repair, guess what? Each one of those got more expensive. So you might need to look at your delayed spending and boost that as well. And then, yes, now's a good time. If you haven't tuned into your budget, if you're on autopilot because you've run the numbers, you're a natural saver, and it's working, now might be a good time to tune into your budget to make sure you know where those dollars are going, like Kevin mentioned.
I agree with you completely, but I can already hear the objections that, man, have you seen what my savings account is paying me these days?
Yeah.
Mm-hmm. I'm earning basically nothing. Why would I pile more money into savings when I'm losing ground? Because inflation is it's rising faster than what I'll ever even come close to earning on those accounts. And the point, though, is being liquid in an emergency that is going to be a bigger emergency by definition. It's going to cost more. Whatever life throws at you is going to be more expensive because of the inflation that we've been encountering. So you need to have more resources to be able to counterbalance that.
Yep.
And so the thing that we're often trying to just reassure folks with when it comes to their emergency fund, that money is not there to build wealth for you. It's there to prevent a crisis from spilling over into your financial life and kind of wrecking the ship, mm-hmm. which means you have to have other assets in your life that are growing and can keep up with inflation or even out ahead of inflation. And, those who are already homeowners have seen the value of their home go up. Those who are not homeowners are feeling like the price is moving away from them. It's getting out of hand. And again, we talked in the last segment about how that can leave you feeling desperate.
Yep.
And you may be jumping into a housing decision that could be an error, could be a problem in the long run. But having assets that can appreciate in value, things like stocks, things like real estate, other hard assets that when life's getting more expensive, they're getting more expensive.
Well, we're going to talk in just a moment about investing during inflationary times. But Kevin, what about debt? What's your thought in inflationary times? Should you go hog wild on debt, or do you stay conservative, or what would you tell folks how to adapt their financial plan?
Well, I would tell you, if you're looking at your housing costs, one of the ways to you can lock in your housing costs, or at least a portion of them, for the next 30 years.
That interest rate, unless you refinance, that interest rate isn't going to adapt with inflation.
Right. But this is where it's very difficult to do, because people say, well, hey, if I retire, am I going to want to stay in this big house, or am I going to want to downsize? Am I going to want to downsize and have a place here and have a place in Florida? And so I think you have to have a great plan. If you look at just the numbers, if it's just a math game, you'd say, well, lever up and have as much debt as you possibly can if we're right about inflation. But I look at that and I say, well, what about the internal finance? Because we don't meet and talk to numbers every day. We meet and talk to people every day.
Numbers would be more fun, I think.
Okay, that was Mike.
In
case you didn't.
His email address is.
I actually like the people. So no, but so as you talk to people, these are souls. These are real people with feelings, and they're like, well, how does debt make me feel? And do I love running with a ton of debt? Because if I had a ton of debt over here and a ton of investments over here, what the thing that you like about one of the things you like about your house is it's not mark to market. Like, you're not seeing it on a day in and day out basis. In 2008 and 2009, when real estate prices plummeted, people panicked about the stock market, and they really weren't concerned about their real estate that dropped by 25%.
And you were grateful if you were debt free at that time. I mean,
yes,
having a lot of debt could be a way for arbitrage, but it increases your risk and makes you less nimble when you're forced to change. Guys, really quick, if we're going to see inflation, how do you position your investments?
I think you have to be positioned for the right amount of growth. If you're too conservative in an environment like this, then slowly over time, silently but steadily, you are going to become more poor.
Yeah.
You know, the inflation, the rising cost of life is just going to erode your spending power, and you have to have enough growth potential. Even if you are someone who says, I don't like the ups and downs, I don't like the roller coaster ride of the stock market, stocks have to be a portion of your investment allocation. It has to be in the recipe that you're using when you build that portfolio.
Because that investment has over time been the best at outpacing inflation. That's it. Like, you could look and say, well, real estate, right? Because the rent will keep up with inflation and the asset will keep up with inflation. It'll keep up with inflation. Yep, that's right. Stocks outperform inflation on average 4 or 5%. Okay, over time. Now, during hyperinflations, will we get flashes of panic? Sure you will, right? But during inflationary times, guess what? Inflation makes companies' value go up as well. And the stock market is an aggregate of those companies' value. So, all right, we've got more on inflation, how it's going to impact your financial plan. That and more coming up on the Wise Money Show with Korhorn Financial Group. I gave you that pause there.
So,
I want to talk about insurance. We'll talk more about investments. Like, let's do this 4th segment on this as well. Because
so no questions.
I don't think so. Because
why is that?
Life insurance, life insurance, long-term care insurance. We haven't talked about that yet. Should it influence your tax plan?
Yeah,
Roth conversion, sort of stuff. Like, so there's a lot haven't hit, and I know we can't say everything, but I would use this 4th segment on this.
I would, yeah, and really, it needs to be speed round on everything we're talking about because there's so much.
All right, let's do it. Does inflation should it influence what you do with your insurance? You might not think so. The answer is yes. We're going to explain right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KF2 studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content online, wisemoneyshow.com, then all over social media, wherever you're at. We are there as well. We're not on TikTok, though, and you shouldn't be either, to be honest. So, but wherever you're at, other than TikTok, search the Wise Money Show. All right, so anything else with investing? Okay, so let's go a little bit deeper. Stocks, only based on evidence, are the best investment to beat inflation. Okay, you would think gold only happened during the 80s. That's it. Gold you call it an inflation hedge. It happened once. It has not happened this time. Gold has not been an inflation hedge. And even over the past 10 years, gold is negative in its investment return. So even if you say, well, but yeah, we've had 2% inflation over the past, gold hasn't kept up. Some argue Bitcoin, and theoretically, cryptos, I would say, should keep up with inflation. I think there's way more than theory happening in that space. It's speculation. And so I don't, a couple months ago, Bitcoin's in the 20s. Now it's in the 60s or 70s, maybe by the time you're I don't know. Well, I don't know. So how can you say that wild of a ride is going to keep up with inflation? I don't know. Real estate, we've already talked about that. Bonds a good hold during inflationary times?
No, bonds are a potentially dangerous investment during inflationary times because anytime you are the lender in an inflationary period, your borrower is paying you back with cheaper and cheaper dollars. It's like you're getting meaningless money. If we're playing Monopoly and you loaned $100 to another player and all of a sudden the banker comes and swaps out $100 bills for $200 bills, you're getting paid back with half as much value, essentially. Yeah. It's worthless play money. Yeah. And that's the concern. That's the outrage I think that a lot of people are feeling right now as we're watching this play out in real time.
I go like this is just internal. I go dynamic on my bonds right now, or something fixed. But I get
A more active trading
Correct.
system, not just buy and hold it blindly. You're saying,
I'd be careful. Or in the buy and hold, a total bond, which is sort of a total bond market strategy that can adapt in different areas because. Yeah, it just looks. I mean, Josh, you're totally right.
Or inflation protected. I mean, there are strategies that you can use on the fixed income side, but when you look at the inflation that's coming, looking backwards, the best hedge against inflation is ownership of equities. Some of the get the best run companies in the world to invest in. Those give you your best opportunity to hedge against this. And you're right, Mike, on a moment by moment, day by day basis, it's not a perfect hedge against inflation. But over the long term, and if you're investing, you're a long-term investor, it's the best way to go.
I'd also say if you're a long-term investor who's diversified and rebalancing regularly, you still want to have some element of bond exposure in your portfolio because sometimes those stocks are going to run up in value like crazy. And if you peel back some of the gains and buy some investments like bonds that maybe are cheap at the moment, you can kind of help smooth out a little bit of the volatility in your portfolio and still get that growth potential that you need to stay out ahead of inflation.
What about with insurance? Does inflation influence your protection plan? We already talked about with health insurance, it certainly could influence the price. We would expect that. Home and auto insurance. I just had a friend of mine a couple weeks ago lost his house in a fire. It's just crazy. And he was told it's 12 months.
12 months to get the house rebuilt?
Yeah, I saw him on Monday. He said, yep, they told us it'll be at least 12 months.
Wow.
Now, that's interesting because on your loss of use coverage in your homeowners, some give you a dollar amount, some say 12 months.
Yeah.
Well, what happens when there's way too many dollars chasing after way too few contractors and lumber's on a boat in the canal and whatever, so how does your insurance cover that? And then second, I've shared, and I don't know his specific situation. I know the house was newer, and so you'd imagine that the coverage on it was good. But if it costs say 20 or 30% more today to build that house than it did 18 months ago, does your homeowner's policy, does the dwelling coverage cover that?
Yeah. It was
Right.
because typically there's some percentage above what the actual number is, but is the actual number correct?
Yeah,
So
right.
I think about that. I think about the business owner who owns real estate with partners and has a buy-sell with specific numbers in there.
Absolutely. You think about life insurance as well, where you say, okay, so I got this $250,000 term policy that's going to cover me, right? During
It
inflationary
did at
times.
one time,
yeah,
right?
during inflationary times. This is my problem. This is our problem with hybrid long-term care life insurance policies. I think that is more the direction the industry is going, and you'll probably need to consider that. However, life insurance is just an inadequate approach for covering long-term care because those costs are going up. If McDonald's was advertising $21 an hour, how much would you need to be paid on an hourly basis to do adult daycare for someone else, for not even your own parent, but someone else? Those wages have to go up. And guess what that means? Cost of long-term care is going to go up as well.
Yep.
And if you've got a fixed death benefit that doesn't adjust with inflation, there's an interesting idea. Buy a life insurance policy that has a death benefit that adapts to inflation. I've never seen it.
Yeah, maybe you just innovated something.
Maybe.
Yeah, and I'm going to go out on a line and say you never will.
Yeah.
Because the life insurance companies win, but you're right. The amount of life insurance that you have, if you're going to have this policy for the next 30 years, that death benefit is getting smaller every year. And you say, well, not really. Yes, really, because those dollars buy a smaller basket of goods and services every year.
Hopefully, you're getting more self-insured.
That's right. As time goes on, you're paying down debt, you're building up assets, and so the need for the life insurance we hope is declining. But that's just an assumption. You may have bought a much larger house since you originally got insured on your life. Life changes. Maybe you have more children than when you first started buying life insurance. And so I think the point here is no matter what type of insurance you're talking about, you need to have a game plan and a systematic way for reviewing the decisions you put in place years ago, because your life is constantly changing and adjusting, and your plan needs to change and adjust as well.
All right. So what about taxes and then even estate planning? And I look at estate planning and say, well, how could inflation influence that? And to me, it's on the tax side, the estate tax side. So guys, will inflation or a season of higher inflation influence your tax strategy?
You have anything there?
Come back to me.
To me, if you own assets that are going to appreciate in value, I'm thinking about your portfolio right now, and it's IRA money, but it could be Roth IRA money, maybe converting dollars from an IRA to a Roth IRA and letting that money appreciate and grow tax-free could be an amazing strategy. So that's something we talk about all the time, just from a tax planning standpoint anyway. But you throw in the inflation wrinkle into that story problem. And to me, it's just another reason to be considering a move like that.
Yeah, I mean, if you're going to be paying taxes on something that's kept pace with inflation, then you'd rather pay taxes today and then let it float and keep pace with inflation.
That was my first thought as well. The other thing, and this gets a little weird. How can I thread the needle here? The economic balance or the in the United States, we're at a very interesting point between those who are financially strong and those who are not financially strong. And I don't want to get into why did they turn out that way. I'm never interested in that debate. But where we stand right now, the top whatever percent owns more wealth than the middle class even. But if you mentioned earlier, Josh, that if you own a house, that's fantastic. If you don't own a house, the affordability of it is just it's very difficult.
Moving away from
right?
you, right?
And if you haven't owned stocks as well or other assets, then you haven't appreciated in this huge run, but you've had to pay more for your goods and services. And so to me, I look at taxes, all of that. And again, I don't know if that came out well or that's an emotional. It triggers a lot of emotions for folks, but that's the way I see things right now. I don't see how they can raise the tax rates on everyone. I don't. I think there will be more discounts for low wage earners and more new taxes on high wage earners. And to me, that suggests Roth or something like that.
But here's the thing. They don't have to raise tax rates in order to hit more and more people, because if wages keep on increasing,
right,
more and more people drift higher and higher into the tax brackets, really without gaining any economic ground though, right? Because the McDonald's worker earning $21 an hour,
that's $42,000.
Yep. So all of a sudden, maybe for the first time in their life, they're starting to pay a little bit of taxes, but are they really any better off at $21 an hour? Because they still buy a Big Mac at $43 or whatever it is now, right? So I don't know. I feel like actually tax rates being level as they are, if they don't move the tax brackets higher, then it's going to start affecting more and more people, and inflation actually comes back to haunt some folks.
True. I guess a different way of saying it is I look at today's tax rates and tax situation as pretty favorable compared to
history.
Yeah, history and what likely could be ahead. So
I agree with that.
Any thoughts on estate tax and those sorts of changes? Does inflation push the envelope on that?
Well, there's been a lot of saber rattling about. Yeah, sure. Inflation certainly does, because if you're properly protected against inflation, to Josh's point, your assets have grown more. And as your assets grow more, it pushes you into now I'm subject to federal estate tax. Yeah. Now my heirs are going to pay more tax because I've got more IRA dollars that are going to pass to them. And so all of the numbers change. And so this is where you have to be really, really aware and have that clarity, the transparency, the visibility, because great financial information puts you in a position to make great financial decisions. So if you're listening to this and you're like, hey, I haven't updated my estate plan in 17 years, it's time to hit the refresh button.
That's right. I mean, Kevin, you hit it. To wrap up, we do believe inflation is here to stay, and it's going to impact your financial plan. We shared with you some of the ways. Work with your certified financial planner to see how this should apply to you. All right, that's all the time we have for today. On behalf of Josh Gregory, Kevin Corhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Corhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Corhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.